Welcome back, Mobile Home Park Nation. Ferd and Andrew here again today with another episode of the Mobile Home Park Lawyer Podcast. Got a special guest today. He's a mobile home park owner, investor, syndicator. He's even a podcaster. Please help me welcome Andrew Keel. Andrew, how you
Hey,
doing?
good. Thanks for having me.
Hey, you got it, Andrew. Thanks for coming on. Well, I know you a little bit, and I think most of our viewers probably do too. You got a pretty public profile, but in case they don't, tell us a little bit more about yourself, your background, and then ultimately how you got into the MHP space.
Yeah, totally. I started out flipping houses around Central Florida. By happenstance, through some yellow letters I mailed out, I came across a couple of manufactured houses that were, near where I lived in Central Florida. Went out, bought them, the individual mobile homes. There was two of them, and got a great deal on them. Bought them both for $2,200 cash, and had no idea what I was going to do with them. So I got on YouTube and I typed in how to make money with mobile homes. And I found a guy named Lonnie Scruggs that had a ton of videos on manufactured housing and creating mailbox money, and Deals on Wheels is a book that he wrote.
I've got it right over here.
And it's a classic, man. I don't know
It
if
is.
you've looked, but if you look on Amazon for that book right now, it's selling for like $800
No
because
way.
they're not printing it anymore. Yeah,
I'm
it's
making a note. I'm selling mine this afternoon. I mean, it's a good book, but $800, good grief.
It's crazy, yeah. But so I wanted to create mailbox money, so I fixed these mobile homes up and ended up selling them on contract, and that's what Lonnie teaches. And ended up doing pretty well. I was able to get like $3,000 as a down payment, and then $250 a month for 5 years on both of those homes that I bought for $1,100 a piece. So it was like I was hooked into the mobile home business at that point, when I realized the demand that I had for these homes that I was selling. So ended up doing that 19 more times with individual homes.
Okay.
And through that process just became, obsessed really with the mobile home park business, and thought that I needed to have millions and millions of dollars to be able to buy a mobile home park of my own, because I was still just trading with the homes. And then I met a park owner that told me, about using other people's money and, being the sweat equity partner, and, just the benefits of owning the real estate versus the personal property that is the homes, with leverage and, tax benefits, et cetera. So eventually started marketing to mobile home park owners, went to the Frank and Dave boot camp, went to a couple other, mobile home park training seminars, and eventually found a deal 5 states away in Illinois, in Edwardsville, Illinois.
Okay.
And contacted someone that I went to the MHU boot camp with and said, hey, I'll be the sweat equity. I just need the capital to take this down. And I didn't have the balance sheet at the time to sign on the loan, so I needed that as well. He agreed to partner with me on that first acquisition, and he took a chance, and it ended up being a home run. I mean, we just hit it out of the park, infilled 7 homes, raised rents, and just increased, management efficiencies. And then we were able to refi within 2 years. And then after that, he was like, okay, well, let's do some more. So then we did 4 more parks together. Those did well. And since then, I've brought on partners, to do syndications, friends and family. And now we're taking outside investors. And we have 23 total mobile home parks that we manage and operate. So it's been a fun ride, and we love the business.
That's great. I think you've probably got a somewhat similar story to a lot of folks in the business, that they started flipping houses, they backed into MHP, where I think you might be different, is you basically syndicated your first deal. I mean, you had
Yeah.
only one guy, but like bringing on, that's hard to do. You must be a good salesman, because it's hard to be like, hey man, trust me, I've never done this before, but trust
Yeah.
me, I need you to sign the note and I need you to put up cash. It's like, wow.
Yeah. And that guy took a lot of risk, and, fortunate for him, the deal worked out because he had the capital, but he didn't have the time, because he had a full-time job and was working a lot, and it ended up working out. But yeah, it was tough having to, raise outside money for my first deal and have them sign recourse, put their neck on the line for our first
Sure.
deal.
Yeah, my first deal, we were actually looking. My dad and I were flipping single family houses and duplexes. We both had regular day jobs, but we were doing that on the side. And he found a mobile home in this park, and he's like, "Huh, the home's for sale." And he thought maybe the park's for sale. And he called in the park, and the guy said no. But we ended up looking at about 20 different parks, and they all said no or hell no. The first guy ended up saying, okay, maybe, but at retail price. We had to pay retail price for it. Um, but it was 695,000. It appraised at like 780.
Oh,
Bank gave us
wow.
100% loan. So my first
Wow.
deal, we had 0% in. We filled like similar amount of lots. I think it was at 48. We got it to 54. Sold it for
Nice.
950 to some private equity group 2 years later. So it was like home run type deal right out of the gate. Like, all right, we need to quit selling. We quit doing single family, and I've since sold off those houses. I got a couple duplexes left that are just kind of easy peasy. But yeah, MHP man, the way to go. So obviously now you got a lot more experience and skill than then, so it's easier to get the investors, easier to justify it. What can you tell us today? I mean, today's market, all I'm seeing here is everything on market. I feel like is very competitive, somewhat overpriced or very competitively priced because all the interest coming in the space. So how are you finding deals now? Are you buying on market or are you buying off market combination? Any tips you can share with our listeners?
Yeah, my tip would be is to spread a wide net. You know, we have a broker relationships that we cherish. We have off market, you know, mailings that we do. We have cold callers as well. I think we're doing a lot of the same stuff. We're just very targeted with where we're going after, and that would be my advice to someone just starting out is, you know, don't start mailing out to the 44,000 mobile home parks on Frank and Dave's list. You
Right.
know, that's been ran through. You know, try to focus on your market wherever that is, and you know, find the parks that you really want to buy someday, and you know, cultivate relationships with those owners. Once you do, you know, get a hold of them and start talking to them.
That's great. Now you're obviously out of Florida, but Florida's a pretty tough market to buy in, I think, because of price and everything and competitiveness. Did you originally decide? You know, you said Edwardsville, Illinois. Did you decide to go outside Florida, or is that just how it worked out? And then what about now? Do you specifically pursue only a few states, or are you looking in all 50 states?
Yeah, great question. When we first started out, we were actually focused on the Midwest. You know, we were following the Frank and Dave model that was
Sure.
taught at the MHU boot camp, and that's really where we got started. And then by happenstance, you know, we just kind of started bolting on properties around the portfolio that we already had in the Midwest. We have looked in Florida, and like you said, you know, the pricing is very expensive. You know, because the real estate itself is so expensive. And we just, you know, the returns wouldn't be as juicy as they were cash flow wise on the properties we were finding in the Midwest. We're also finding that a lot of the all age communities in Florida, you know, are not of the same caliber. You know, the 55 and older A grade communities around Florida are very nice. But then, you know, several of the all age communities just were of lower quality, and we can get better quality assets, infrastructure wise, and everything in some more secondary markets in the Midwest.
Sure. Now, speaking of secondary markets, do you have a size limit on the metro? Most people like, you prefer 100,000 metro, like Frank and Dave say at the boot camp. I've been to the boot camp too. It's a great course to get involved in. But at some point, I got a guy that's a wholesaler call me today. Hey, how small will you go? And it's like 5,000 is a little scary.
Yeah.
25,000. I'm kind of like, what's the job status? Is there a prison there, a hospital, a university, more than one factory? So I've personally have gotten under the $100,000 metro on several occasions. Do you have a firm line like that, or do you look at just deal by deal, or how do you go about those metrics?
Yeah, it's deal by deal. You know, we aim for 50,000 in the metro. That's kind of a baseline. Now, if it's under that, then other things need to be perfect. You know, we kind of have some give and take there. But we do spend a lot of time looking at the jobs available in a market. And we probably spend more time on that than kind of evaluating the population numbers and things like that.
Got it. Makes sense. So that's part of your site selection is looking at job numbers, and that's obviously part of not due diligence as much as like preliminary underwriting, selecting where you want to go. What other underwriting tips can you share? Do you have any special sauces you're willing to share that or maybe a horror story that you didn't count the lots? I had that happen one time where I was out of town. My assistant counted the lots, the appraiser counted the lots, and it was 84, I think. There's 86 in the park. We got 2 free lots, but
Yeah.
my appraisal didn't come in as high, so I had to put in more cash. It was like, wow. So I'm like, we're mapping them out, and we're going. I mean, two people go verify that the lots are the exact. So that's a horror story. Like I, embarrassed to say, we had to come up with like 30 grand
Oh,
extra
geez.
equity the day before closing because we were off by 2 lots or something, and we really weren't. So anyway, that's
Yeah.
that's a tip I have is count the damn lot yourself.
Count the lots. Totally. Yeah. Um, I would say for an underwriting tip, we spend a lot of time on the utility infrastructure and getting those, and we spend a lot of money. Like we just had a deal that we're working with you on in Kansas that actually fell apart like a couple days before closing. And basically, we spent a lot of money on getting the utility infrastructure looked at and inspected from plumbers and electricians. And when it falls apart, in the final quarter, it's unfortunate. But that's just something that we're really adamant about is checking out the infrastructure. And then you can change a lot about a piece of real estate, but you can't change the market, right? So if there's not diverse employment in some pretty steady, stable industries, that's something we would likely pass on because we don't want a one-horse town, as they say.
No, I think that's prudent. Yeah, I've got a park right now that I'm in the process of refinancing onto agency debt specifically to get off the recourse because it's a 2-horse town. It's not one, but it's got a meat plant and then like an outdoor sports plant. And so I'm like, man, I have an all Hispanic tenant base and they work at those two factories. I'm like, we got a third one, third another. I'm like, if those places go out, I'm gonna be a little nervous. So I hear you, but when they're on the due diligence, I think that's really prudent to spend the money up front. And it's harder when you're getting started. It's like, man, am I going to spend 5 grand on this kind of thing? Can I? And it's just tougher. But I think you need to on the infrastructure. You need to on your other third-party reports. Like I've got a deal here in Missouri. Surveyor's going out there tomorrow, and the survey's like $6,000. And I already paid for. I already got loan approval, so I got a $3,000 appraisal. I got a $2,000 phase one. I got a $6,000 survey. So I'm in for 11. Surveyor says a neighbor came over and told me this property was subject to a lawsuit a couple years ago based on a boundary dispute, and the seller's a bastard. And I was just like, you gotta be kidding me. Because he was supposed to in his contract disclose this kind of stuff, give me copies of prior surveys, which he said he didn't have. And now I'm 11,000 pregnant and I may have a problem. It's like, it's always hard to stomach that, but it's just part of doing business, unfortunately. So it's a hurdle, but I'd rather spend 11 and not buy a problem then This is like an $800,000 deal than buy an $800,000 problem,
Exactly.
So
Yep.
it's easy for me to say as the lawyer. You should definitely don't be cheap on legal fees, all that kind of stuff. Self-serving, but I'll tell you, Andrew, I listened to one of your podcasts on your show, and you were talking about some of your management and manager training tips with like Trello and Slack and some of these, I got my legal pad here. I'm old school, right? You got some sophisticated systems there. Can you give us a little insights as to how you train your managers with those sort of say higher tech methodologies?
Yeah. So one thing, one software that we use is called Slack, and some people may be aware of it. It's like a communication chat platform. It has a mobile app and a desktop version, and that has been monumental for us in our management of these communities. It just saves so much time. And we love our on-site managers. I mean, I truly feel that a lot of them are underpaid for what they do for us because they are just our eyes and ears, keeping eyes on everything, keeping tabs. But just one thing we've picked up is that the on-site managers, they just love to chat your ear off. And if you start a conversation, you needed just a quick 30-second answer, and that could end up being 30 minutes really quick. So we switched over to using Slack, where it's a chat platform. We can ask a question and they can respond right in that platform. They can send photos, they can send videos, they can send PDFs and everything. And then it keeps the log, the history. So if they asked a question once and you answered it, they can go back and search for that answer again. And that's just been really, really valuable for us. And we create a channel for every community that we have. And then we put everybody in that channel. And that's how the on-site managers communicate with us versus, text messaging or phone calls, et cetera. We also do weekly Zoom calls with them to kind of, get an overview of that week and discuss the KPIs, the key performance indicators. So that's one of the platforms we use is Slack. Highly recommend that. Trello, as you mentioned, is another like project management tool that we use, and that's more used by our off-site, management team to manage vacant lots, manage infill projects, manage homes that are up for sale, collections, etc. That platform it's like a digital whiteboard and just helps us keep everything organized with real-time photos and everything. So those are two, pieces of software I recommend. We also use Rent Manager,
Sure.
for invoicing and accounts receivable. So that's a great platform. And overall, with those three, you have a head start, because I think, like you said, a lot of operators now that are like your mom and pop type, they may be using a legal pad or a general ledger,
Right.
with a written rent roll and things like that. So that
No,
should
it
give you
that definitely sounds a little better than the old legal pad method. So yeah, and I was kidding. We use some systems too, but that stuff sounds great. And yeah, Rent Manager. I just did a little Zoom podcast on it the other day. I feel like it's an amazing tool. There's definitely a learning curve and some brain damage to figure out how to use the systems, but once you get up to speed, it's like, man, that's powerful. Especially, if you're syndicated deal, you can, click of a button, you can kick out, trial balance or profit and loss or balance sheet, rent rolls, all that kind of stuff. It's like, man, that's just, your investors want that kind of stuff.
Yeah.
And I've invested in some deals in the past as an LP, and I've had promoters that didn't do that kind of stuff. And then it's like, man, when they see the capability that you could have done, it's frustrating. Like, you guys are literally using Excel, and you've got a $50 million fund. Like,
Yeah.
blows my mind. And rent manager's not that expensive. And there's other similar products out there that it's not that expensive for what you get. So definitely the way to go, I think.
Totally. And we just started using InvestNext for our like investor management system. And we just sent out our first quarterly emails, quarterly reports through that system. And we like that so far, because you can send like ACHs to investors right through the platform pretty easily. So that's a new one that we just started using.
Great. Yeah, I've heard of a couple different those type softwares. You can even send your K1s and all that kind
Yeah.
of stuff, and just have them uploaded instead of having to email them or mail them. Yeah, I still get some K1s in the mail, and tax it's like, good grief, how many trees are we killing for all these different, K1s? But some people like it old school and want a hard copy, and who's going to tell them no, right?
Exactly. Yeah.
Uh, this is great. What other tips or tactics? Anything else you want to share with our audience? Tips that you've learned in the business, or horror stories, or anything like that?
Yeah, I mean, cost segregation studies, I'm a big fan of those.
Oh, yeah.
Every year on new acquisitions, I just think that that's just a huge tool, especially with the bonus depreciation. I don't know what your thoughts are on the cost segregation studies. I mean, a lot of
Oh,
people look at the price tag and they're like, oh, that's expensive, but I think it's worth its weight in gold.
yeah, we use them, and I mean, I think that Yona Weiss was on here a couple weeks ago. We used his company, and he kind of recommends it's under a half a million. You may not need it. Over half a million, you do. So I bought a deal, two of them right at the same time. One was 1.4 and one was 135. Just really cheap. It was actually 65 Space Park I got for 135. So it was a
Wow.
good deal.
Yeah.
But I don't want to pay for a cost seg on the $165,000 park. So they basically, with talking to my CPA firm and my cost segregation firm, we were able to utilize some of the same percentages and formulas on the cheaper part. We paid for one study, we used it for free on the other. And if we get audited on the other, like we didn't have the engineer look at this one because the $3,000 to $5,000 price tag for those things
Yeah.
didn't really make as much sense on 165, especially with short term hold and flip. We since sold it. But I was able to use some of those methodologies, and yeah, I'm a big fan. I'm a big tax guy. I read the whole audit technique guides. It's like 106 pages. I read it 2 nights. I was like, I'm going to become a tax law expert because of you've seen the power of the numbers on those studies. It's like,
Yes.
good
Yeah.
grief, it's
Totally.
I've got 3 deals right now where we have to close one in December. We can close 2 others. Our due diligence would allow us to close them in January. But I told the banker, I said, December 28th, because my anniversary is the 31st. Got a party on the 31st. We're not gonna do that the last minute. we're trying to get them closed in 4 weeks for that reason, to take
Yeah.
the tax write-offs in 2020, especially with the new administration coming. God fury, what's going to happen with tax code if Biden gets his hands on it. Super biased on that, but I think
Yeah.
that's going to be a big deal for real estate investors, for MHP guys. So you can, I'm of the opinion if you can close it before the end of the year, close it.
Definitely. Yeah, no, I agree. I wish we had more deals in the pipe to kind of finalize before the end of the year. But yeah, that's a good point, to try to push and get deals done before the end of the year.
Yeah, I think so. Well, this is great, Andrew. Where can people find you if they want to reach out to you or for your projects or just your podcast? Let us know here.
Yeah, for sure. If you'd like to get a hold of me, I do have a podcast called the Passive Mobile Home Park Investing Podcast. You can find me there, or you can check out my website. It's keelteam.com. That's just KEEL, team, like a basketball team.com.
All right. Thanks, Andrew. Appreciate it.
Yeah, thank you, Ferd.
You
Appreciate
got
you
it.
having me.
You're welcome.